Every single year, the world's most powerful central bankers get together in Jackson Hole, Wyoming. And every year, the markets pretty much hold their breath for one specific speech, the one from the chair of the U.S. Federal Reserve. So today, we're going to break down Jerome Powell's latest speech and get into exactly why it sent the entire global economy into a frenzy.
And you know what? That's not an exaggeration at all. You really can think of this as the Super Bowl for economists and big-time investors. The second that speech hit the wires, the reaction was instant, it was dramatic, and it tells us a really fascinating story about what Wall Street thinks is coming next. So what did that reaction actually look like? Well, let's take a look. Stocks, right, represented here by the S&P 500, they rallied hard. Then you have the riskier stuff, like Bitcoin, which jumped even more. And at the very same time, the US dollar got weaker. Now, this is a classic risk-on signal. It means the market heard something it really liked. But what on earth was it?
Well, it all comes down to one word: dovish. The market heard Powell's speech and decided it was, mildly dovish. That just means he sounded less aggressive, less hawkish about fighting inflation and jacking up interest rates than a lot of people were afraid he would. And that little hint of ease your money down the road, that's what sent asset prices flying. But this dovish tilt comes at a time when the Fed is facing a massive dilemma.
And yeah, that dovish tilt takes us right to the heart of the Fed's biggest problem, this incredibly high-stakes balancing act that is just getting harder and harder to pull off.
Okay, so you gotta understand, the Federal Reserve basically has two jobs, assigned to it by Congress. Job number one, keep prices stable. That means fighting inflation. Job number two, keep employment as high as it can possibly be. Now, most of the time, those two goals get along just fine. But right now, oh man, they are in a head-on collision.
And listen, those aren't just my words. Powell himself said it, plain as day. He admitted that the tools you'd use to cool down inflation, like raising interest rates, are the exact opposite of what you'd do to help out a job market that's starting to look weak.
This whole situation puts the Fed in just an unbelievably difficult position. I mean, what is a central bank supposed to do when inflation is still a major problem, but the job market is also starting to crack? This is the tightrope Powell is walking right now, and nobody wants to see him fall. So let's dig into the first piece of that puzzle, the American labor market. Because, on the surface, everything looks great. But once you start peeling back the layers, well, the picture gets pretty confusing.
So on one side of the scale, you've got this number, 35,000. That's the average number of new jobs created each month over the last quarter. Now, just to give you some perspective, a healthy, growing economy often adds hundreds of thousands of jobs a month. So this isn't just a slowdown, my friends. This is like slamming on the brakes. It's a huge red flag that the economy is really losing steam.
But then you look at this number, and that's where the confusion really kicks in. The unemployment rate is still just 4.2%. That is incredibly low, historically speaking. So we've got this paradox, right? Companies have stopped hiring, but they're not really firing the people they already have. It's this weird, fragile piece, and honestly, nobody is sure which way it's going to break.
Powell himself called it a curious kind of balance. It seems like both businesses and workers are kind of pulling back at the exact same time. Fewer companies want to hire, and fewer people are out there looking for new jobs. It's a delicate situation that could snap at any moment, and that has the Fed very worried.
Okay, so that's the employment puzzle. Now let's switch gears and look at the other side of the Fed's mandate, inflation. And if you thought the labor market was confusing, hoo boy, this is where the story gets even more complicated.
All through his speech, Powell kept pointing his finger at one main culprit for rising prices, these new trade tariffs. He basically argued that they're the thing adding a new layer of complexity and pushing the prices you pay for things higher.
And this is where things get really interesting. This chart illustrates the central debate perfectly, because when you actually break down the numbers, the inflation coming from goods, the stuff that tariffs actually affect, is just a tiny little sliver of the pie. The huge majority of inflation is coming from services and housing. And that kind of suggests that maybe, just maybe, the tariff story isn't the whole story.
The big fear, no matter what's causing it, is this thing right here, the wage price spiral. See, if prices go up, your paycheck doesn't go as far, so you demand a higher wage. That can cause companies to raise their prices again to cover the costs, which then leads to more wage demands, and you get stuck in this really dangerous, self-fulfilling cycle of ever higher inflation. And preventing that spiral all comes down to what people believe is going to happen with inflation in the future.
Powell keeps insisting that the public's long-term expectations are well anchored, but crucial survey data from the University of Michigan shows that people actually expect inflation to stay significantly higher than the Fed's 2% target. This disagreement isn't just academic, it's at the very heart of the entire policy debate.
So, you've got a confusing labor market on one side, a really complex inflation picture on the other. How in the world does the Fed move forward? Well, they've decided the old rules just don't apply anymore. It's time for a whole new playbook.
And this isn't the first time they've done this. The Fed's strategy has been evolving. After the 2008 crisis, the big boogeyman was low inflation. That's what led to that 2020 makeup strategy. But then the post-pandemic world hit us with the highest inflation in 40 years, and it became painfully obvious that the old playbook was completely useless.
And let's just be absolutely crystal clear about this. That 2020 strategy is officially dead, gone, buried. The idea that the Fed would intentionally let inflation run hot just to make up for past periods when it was too low has been totally, completely abandoned. So this new framework makes three really important changes. First, it admits that near-zero interest rates aren't the only problem they have to worry about anymore. Second, it got rid of some specific wording that basically tied their hands, and now they can act preemptively against inflation. And third, it formally recommits them to a balanced approach when their goals on inflation and employment are fighting each other, which, as we know, is exactly what's happening right now.
At the end of the day, the new strategy all boils down to one thing: credibility. Powell is sending a clear signal that the Fed will do whatever it has to do to convince you, me, and everyone else that they have inflation under control for the long haul. Because that belief, that's their single most powerful weapon.
So the Fed is adapting. They are writing a brand new playbook for an economy that looks absolutely nothing like the one we had a decade ago. They're staring down a puzzling labor market, a complicated inflation fight, and just a deep fog of uncertainty. The $1 trillion question is, in this strange new world, will this new strategy actually be enough to get them through the storm?